Hi, this is Jeffrey Cohen, April 22nd, Chicago Quantum. How are you? So, I'm a registered investment advisor and I'm here to talk to you about stocks and I'm here to talk about what we found in our model. And so, let's see. First thing I'm going to talk about is that we ran our model last night and we picked some interesting stocks. So, top dividend paying stocks is the Carlyle Group, CG, and Blackstone, BX. We also noticed that the variance of the S&P 500, price variance every day based on closing price, it's been about the same. Now, the returns of the market have been really low. So our model is only predicting a 4.6% return next year. That's inclusive of dividends. That's a tough place to be in this stock market. Do you know the actual NASDAQ return, the NASDAQ composite top 100, was negative 1% last year? The return of the Russell 2000 down 10.4% last year. And the S&P 500 index was up 6.7% last year. The problem with these returns is they're just not that high. And when you have a low risk-free rate of return, short-term money, you're maybe only going to earn 4.6% in the market. So what do? So we run our model. If you're listening, you know who we are. And we looked at 11,000, it's crazy, 11,276 stocks last night. That's how many stocks traded in the U.S. stock market. We validated down money-making stocks. This is our uprun. We also do a down run. The uprun had 2,384 stocks. And we had 253 trading days, contiguous trading days, data of every one of these stocks. So the expected return, if you held all the money-making stocks, is 5.52%. It's not bad. Your variance is higher than the S&P 500 variance, but not by much. So the S&P 500 variance is 9.1 times 10 to the negative fifth. The variance of the all stock portfolio of money-making stocks is 1.2 times 10 to the negative 4. So you're close. Okay, we have leptokurtic stocks, we have platykurtic stocks, we have very interesting stocks. By the way, I've had COVID now for 8 days, and last video we did, I said don't catch the cold that I caught. Well, don't catch it. I've been under lockdown now, my 8th day. And unfortunately today and yesterday, the symptoms I got my first day came back. And so this COVID thing's pretty tough, but we're fine. Just not feeling well. So leptokurtic stock is a stock with a bell-shaped curve that is very narrow, very pointy. And so your leptokurtic returns are very much right around the mean returns. And so those are stocks that aren't moving a lot. They're not flat. They don't have fat tails. They're very narrow tails. They're very inherently less risk in the returns of the stocks. And we actually noticed the tobacco stocks are slightly less leptokurtic, but low variance, kind of interesting. That's MO and PM. We notice AppV is in the list. And the rest of the stuff's kind of weird stuff that you might not want to invest in. We also have platykurtic stocks. And so these are stocks that have a pretty wide distribution of returns. They're either up or down. They're not really acting real tight. And I will say that Walmart has recently gone from being leptokurtic to platykurtic. And if you notice, Walmart has gone up like 10 or 15% in the past couple of weeks. So it's still low variance because over a very long period of time, Walmart stock doesn't really move that much. But in the short term, it's gone a little bit, little crazy. We like Walmart, and we've been following it carefully. When you have a very low return in the stock market, it's very hard to pick stocks. It's much better if it's a low return to market and you have to be invested. Just buy the index funds. Buy QQQ, buy SPY, buy IWM, or go to Vanguard. We use Vanguard. Buy some of their low-cost Admiral funds, index funds. Just passively invest. You're fine. Because it's very hard to find stocks that are going to outperform the market in terms of efficiency and effectiveness. So our model, instead of running for 2.5 hours when the market's going great, we ran it for 6 to 8 hours last night. And in fact, the best portfolios to pick are larger now. 6 stocks to 10 stocks, all evenly held. We still see a lot of tech in there. We see a company that finances Bitcoin investments. We see a lot of semiconductors. We see a software company. And we see some up and coming kind of growth stocks. And so this is so interesting. The model still likes you to put your money into high beta stocks, and but to group them in a way that you get, good returns, safer returns. What else was interesting? So a lot of you like negative beta stocks. I read a lot about negative beta stocks. We're gonna protect ourselves against a downturn in the market with negative beta stocks. So there is one type of investment that acts like that, and that is gold stocks, gold mining stocks. So if you actually held physical gold, you're, for the past year, running a negative beta of minus 9%. Now, a 100% beta means it operates just like the S&P 500. A negative 100% or negative 1 is operating directly opposite of the market. 9% opposite means you have a little negative exposure. It's kind of nice. Newmont Mining, Newmont Corp, NEM, has a 10% negative beta. In fact, if you just invested in a fund that holds the US dollar index, you have a negative 12% beta, which is kind of interesting. So I guess the reality is, if you want to have some exposure, some kind of negative exposure to the market, hold a little gold, hold US dollar funds. You can take care of that. The challenge is it doesn't always work, and it doesn't work perfectly, right? There's other negative beta stocks, but they're really effectively zero beta stocks, like Clorox, negative 3%. Codoris Valley Bancorp, negative 3%. Eastern Corp, negative 5%. First Savings Financial Group, negative 1%. So the reality of these kinds of Hormel Foods, negative 2%, is that effectively these are operating. Kellogg, negative 1%. They're operating independently of the market. They're operating like utilities almost. Now, you have a lot of stocks that paid high dividends last year, but that are probably not going to pay the same dividends this year, with a few exceptions. There are master limited partnerships. These are traded limited partnerships that are listed in the stock exchange that do things that generate cash. Now, what happens is, when you have a limited partnership, all of the earnings and the costs flow through to you as a limited partner. We own a limited partnership that we really like, and there's others in our model that have paid very healthy dividends. USA Compression Partners, they paid a 14% dividend last year. That's pretty nice, right? You've got Shell Midstream. So they operate pipelines, or they operate technical capital infrastructure that's used in the oil and gas industry, right? And so they pay out, and it makes sense. I mean, even Saudi Aramco, which went public, talked about spinning off its pipelines, because they generate losses, they generate dividends. It's a very good tax advantage investment. Master limited partnerships. If you ever want to call me, I can talk to you about it. And that's about it for today. So market is not doing great. Market's down, right? You're not seeing big returns. I mean, you're 4.6% estimated return for next year. You're almost better off, almost in the bank. But if you're going to put your money in the market, put it in the index funds. But if you really want to invest in some dividend stocks or take some risks on some leptokurtic low variance stocks, that's great. Our model, just to summarize up, I've got a voice in my head, right? It's a guy from Virginia, always asking questions, right? I love this guy. And he always says, Jeff, what industry sectors are going up if the market turns? Where's my exposure? Where should I be? Okay. By the way, COVID sucks. Again, in case you forgot from earlier in the call. Hate it. Semiconductors, chip makers, very attractive when the market turns around. Money managers, awesome place to be when the market turns around because they get paid based on the returns of their investments. And surprisingly so, large cap tech. It's so rare that you would see a stock like Microsoft is the 21st stock at a 2,350. Microsoft pays a dividend. It's down 4% on the year. It's attractive. It's going to pay like a 7% return next year. That's not bad. Alphabet, Google, GOOG and GOOGL. By the way, GOOG is slightly better. That's nice, right? You got Google. What other big? Apple, number 41 on our list. It's crazy. Pays a dividend, up 9% last year, 7% expected return next year. You know, when I think of Apple and I think of like Alphabet and I think of Microsoft, I think of high flyers. Do you know all three of those stocks are either down slightly or up slightly over the past year? And so net, semiconductors and chips, money managers, and the large tech. That's what's going to really recover. And then about a week ago, we told you we saw Johnson Controls climbing the list. JCI, Johnson Controls International, out of Milwaukee. They're on our list. They pay a 1.8% dividend last year. Stock's down 7%. It's pretty good. It's within statistical rounding error, the S&P 500 index. And you're supporting a local Wisconsin manufacturing business. Thanks very much for being part of this. Thanks for listening. Hope you like it. By the way, if you like these videos, it's really helpful to me. Leave a comment. We can have a little chat, right? I'll respond to your comments. And then there's a red button, a subscribe button. If you really like it and you want to know more about when our next videos are going to be, hit the subscribe button. Really helps. Thanks so much. You take care now.